Hey guys, how's it going? It's Andy from Magoo Investing. Happy Thursday. In today's video, we're going to be talking about some of the really important news that came from the election about two specific stocks. And if you've been on the channel for a little bit, we're going to be talking about Uber and Lyft today, by the way. This was a huge roadblock for me to ever consider taking a position in these two stocks. And so after the election, Uber and Lyft are in a significantly better spot. So in today's video, I'm going to explain what happened with the election in case you weren't aware of what happened. And then I'm going to talk about kind of Uber and Lyft apart and kind of describe what I like and don't like about each of these companies. And then towards the end of the video, I'm going to compare them and decide which one, if I had to take a position, which one I think is the best buying opportunity. But before getting started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I really appreciate it. Hit the like and subscribe button, as would help my channel out a lot. With that out of the way, let's hop right in and talk about AB5, Prop 22, and Uber and Lyft and where they're going to be going from here. Okay, so as I mentioned, we're going to be talking about AB5 and Prop 22. So AB5 was Assembly Bill 5 in the state of California that was passed, I believe, in November of 2019. And the whole idea behind it is that the state of California has argued that people driving for these ride-sharing companies like Uber, Lyft, DoorDash, they should be employees and not considered contractors. And as a result of that, they'd have to be paid significantly more. They'd have to have health insurance, and there'd be a lot of additional costs put on top of these businesses. And so when that went through, there was a point where it was looking like some of the companies were going to have to leave the state of California. And if you just think about how big California is, that'd be a huge hit to their companies. At one point, Lyft was less than 24 hours away from leaving before a judge actually postponed that. And as a result of what happened, Prop 22 was created, and this was mainly funded by all of these ride-sharing companies. So in total, $200 million was put to invest in a Prop 22 to get it on the ballot, and that came from companies like Uber, Lyft, DoorDash, Instacart, and Postmates. And so with the election just happening, Prop 22 was on the ballot. And I want to talk about how I voted, because I do vote in California. I ended up voting yes to keep the workers as contractors. When I first saw this bill, I thought it was immediately going to be something that I was going to vote in favor of the drivers. But then doing a lot more research and finding out that almost 80% of the drivers would rather be considered contractors, because there's a lot of extra requirements that would go into them being employees. There would be a lot of layoffs, stuff like that. And so I ended up voting yes, and it appears at this point like it's going to pass. And as a result, all the drivers are going to be considered contractors from now on. And this was very important to watch this election, because there are a lot of other states, I believe New York, New Jersey, were also considering putting something similar on the next ballot. So seeing that California voted to keep them as contractors might keep that at bay for a bit. However, from Prop 22, there will be some additional costs put onto Uber and Lyft. Comes from stuff like minimum earnings, healthcare subsidies, and vehicle insurance, but it's going to be significantly less than what it would be if they were full-time employees. So now that I've talked about what happened on Tuesday, let's kind of break down the two stocks, because this was the biggest roadblock that kind of stopped me from investing in these companies. And now that Prop 22 has passed, the companies are relatively safe now. Let's talk about the long-term future of these two companies. So first, let's start off with Uber. Uber is trading for $40 and it's up 35% on the year. And on Wednesday, it jumped 12% at the time of recording this. Looking at the data, Uber is the most used ride-sharing app out there. As of right now, I believe they have around 68% of the market, but that has slid a little bit from 72% that they had back in 2017. So they do have the majority. It's still a pretty solid majority, but they are losing a little bit of ground to Lyft. During the pandemic, Uber has been hit significantly. You can look at people just aren't going out as much. People don't need to drive around the town as much. And so their revenue was down significantly. But they were kind of saved revenue-wise when it came to Uber Eats, because most people aren't able to go out. And what's something that you can still do that kind of feels like normal life? You can order out food from restaurants. And so Uber Eats was a saving grace when it came to their revenue in the past couple quarters. So let's break down their revenue sources. I'll put this graphic on the screen right now. The most interesting thing to point out is that Uber Eats is actually the largest part of their business by revenue, and it has overtaken the mobility or the driving aspect, which is super interesting. Looking at the breakdown, in the last video that I talked about Uber, I didn't really talk about freight. I think freight is very interesting. However, it's still a relatively small part of the business, but it is pretty exciting. It has been growing at 26% year over year. Could be important in the future, but it's not something that I'm watching as being a key deciding factor on why I do not take a position in Uber. So looking at quarter two, this was during the middle of the pandemic. We saw some really interesting things. The total sales for delivery was $7 billion, while mobility, which is the driving aspect, was only $3 billion. Delivery revenue had $885 million compared to $793 that came with the mobility. However, when you look at how much money, the net profit or loss that they had from each of these segments, the delivery had a net loss of $232 million versus a profit of $50 million for the mobility side. So how do I feel about that? In my mind, Uber Eats is a very questionable business. While food delivery has spiked recently, it has become more of a social norm at this point. Uber Eats only controls 22% of the overall market, which in my mind, I would have expected it to be pretty close to the data that we've been seeing for the ride sharing, maybe closer to like 65, 70%. And I was very surprised to see that DoorDash holds 50% of the overall market share. And so Uber has been trying to become a major force in this area. And the way that they try to do that is they try to buy Grubhub, which was around 20% of the market. That failed, and then they ended up buying Postmates for $2.65 billion. But that only gives them 8 additional percentages for the overall market. And so the main problem with this business is that margins are razor thin. Margins are the efficiency that a company can make profit based off of the amount of stuff that they're selling. And so I've always talked about margin as being super attractive on something like Southwest because their costs are relatively low. So when they bring in money, they're very efficient at turning revenue into actual profit. And so in this delivery business, your margins are razor thin. Think about it in a way of the surging prices that you have for Uber. If you go out on a Friday night, I mean, you can't at this point, but if you went out on a Friday night in the past, you'd expect the cost of a ride to be significantly higher on a Friday night compared to like a Sunday morning. Just because the demand, it's economics. I don't want to explain it that much. But I've had people take $50 Ubers and be totally okay with that because that's just kind of the expectation. Everyone, most college students at least, know how much a Chipotle burrito is. And so if for some reason during a special time of the night, the Chipotle burrito was twice as expensive, I don't think people would be okay with that because they know what the expected price is going to be. And so the margins are razor thin. And we've seen this because Uber Eats has just been losing money like crazy. I found this article from 2019 saying that Uber on averages loses $3.36 per order on Uber Eats, and they hope to get that down to a 50-cent loss on each order by 2024. And so for a company that has been focusing and has always preached that they're trying to get to profitability, I don't understand why they keep doubling down on this business. It saved them on the revenue aspect of it, but their profitability hopes are kind of declining as they continue to expand this business. And then the company has a couple of strange deals going on that I'm really confused about. So they do have a partner with the electric scooter company Lime, and if for anyone else like myself that lives in a major US city, you know how frustrating these are. I know in San Francisco people have been collecting them, burning them, throwing them into the bay. This is not a very well-liked company, and it's very strange that they keep putting money. They had another round of funding, and a lot of it came from Uber. I thought that was very confusing. And then the most questionable thing, their ATG department is stuff that's working on some of the exciting stuff like the driverless cars, but they have a deal with GE to make flying rideshare business, which just seems so strange to be focusing on that when they haven't even gotten the full approval for the self-driving cars. And then going back to the self-driving cars, and they're actually losing that battle to Lyft, who has a partnership with the Google company, which is called Waymo, to make self-driving cars. And so losing that. Oh, and then the head of that program for the ATG is going to jail after a $4 billion lawsuit about him stealing trade secrets from Lyft and Waymo. So when I look at Uber, I feel like they're not focusing on the right things. Obviously, I'm not a business expert. I'm just 23. But looking at it, the company has always preached that they want profitability, and it seems like they're focusing on the wrong areas of their business to try to make that happen. Then going to Lyft, unlike Uber, Lyft is actually down on the year, and it's pretty significant. They're down 34%, and it's currently trading around $28.50. And so Lyft has been hurt significantly, more than Uber, because they do not have the delivery aspect of their business. So when people aren't going out as much, they're not able to counteract that loss in revenue with a spike in delivery. So they've had huge drops in the revenue during the pandemic. Lyft has a much smaller market share, but I think that's a good thing because they're focusing on one singular thing, and I think they're really good at it. Like Uber, Lyft's most important metric is going to be profitability. And I've seen some really positive things coming out of the company in the past couple months. They've had $300 million in cost savings that will continue annually, and they believe that profitability will happen with 20 to 25% fewer rides, and believes it'll only take $5 billion in annual revenue to become profitable. In 2019, their revenue was $3.6 billion. And looking at that annual revenue, the annual increases look fantastic. 2020, probably going to be tough based off the pandemic, but I think it's pretty reasonable for them to reach $5 billion in revenue in 2021. Lyft has also gotten into the rental business, which I think is a much better business to get into than delivery, just because, I don't know, you can fluctuate the price. You have probably a lot higher margins than you would with delivery. I think that's way better. And then they have that partnership with Google and Waymo to work on self-driving cars. So overall, I think Uber and Lyft are definitely in a better spot than they were a couple weeks ago. With Prop 22 passing, the light at the end of the tunnel isn't a death sentence to these companies. And so that's why we've had this massive boost in their stock price. However, when I look at these two companies, I see a lot of risk, and one has significantly more risk than the other. When I look at Uber, obviously they are the leader in the sector when it comes to the proportion of the market cap. But I just don't like the trajectory of their business. I think they're spending so much money on delivery, which has been incredibly unprofitable for them. And so when I look at these two businesses, I think Lyft is significantly better. One, it's at a significant discount of down 34% on the year. They only focus on one area of their business that they're really good at. They've continued to keep their guidance even through the pandemic of trying to reach profitability by 2021. And they've given out metrics for how they think they're going to get there. So overall, I think Lyft is a better investment for my type of investing style. Obviously, it does have a lot of risk associated with it, considering the pandemic is ramping up at this point again. But right now, I think Lyft is a better opportunity for a long-term investment than something like Uber. And I'm very curious to see what you guys have to say about that. Last time I talked about Uber was probably the most disliked video on my channel. And I expect this video to have a similar amount of dislikes. So let me know what you feel about these two companies in the comment section down below. Thanks for watching this video. I appreciate all support, and I will see you tomorrow.